Hey everyone, and welcome back. We talk a lot about how to spot and trade liquidity sweeps. But today's lesson might be even more important. We're going to talk about when not to trade them. Because knowing when to sit on your hands is what separates consistent traders from those who constantly give back their profits. Let's set the stage. A liquidity sweep is that classic move where price spikes through a key high or low, grabs all the stop losses, and then reverses sharply. It's a powerful setup. But if you trade it blindly, without context, it will burn you. Understanding when to avoid this setup is absolutely vital for preserving your capital and improving your consistency. Just a quick refresher, a liquidity sweep is an institutional move. Big players push price beyond a clear liquidity level, like a previous high or low, to trigger a cluster of stop orders. Once those orders are filled, the market often reverses direction. The trap for retail traders is entering as the breakout happens, right before the reversal. So why do traders get caught? They enter impulsively at the breakout point, they mistake the liquidity grab for a new trend starting, and most importantly, they ignore the broader market context. This is the golden rule: context over setup. A liquidity sweep is just a pattern. It only becomes a high probability trade when it occurs under the right conditions. Trading every single sweep you see will lead to losses. So, let's get into the specific no-trade zones. First up, low volume sessions. Think about the time after the London close or before the Asian Open. The liquidity is thin. A small order can cause a big spike, but it's often a false signal because the major institutional players aren't actively participating. The moves are exaggerated but unreliable. Next, and this is a big one, avoid sweeps that go against the dominant higher timeframe trend. In a strong, clear uptrend, trying to short every little liquidity grab above a high is a low probability game. The trend is your friend. Don't fight it. The sweep is more likely to lead to a continuation, not a reversal. This should be obvious, but it's worth repeating: never trade sweeps during or right after a high-impact news release. Events like NFP or CPI create chaotic, fundamental volatility that has nothing to do with technical liquidity levels. The price can just keep running. Always wait for the dust to settle and for a new market structure to form. If the market is choppy and directionless, with mixed highs and lows, avoid trading sweeps. This kind of price action often indicates that algorithms are just collecting liquidity from both sides without a clear directional intent. Wait for the market to make up its mind and establish a clear range or trend. Be very cautious right before a major session like London or New York opens. The market often performs these pre-game liquidity grabs before the real directional move begins. A good rule is to wait 15 to 30 minutes after the session open to see which way the institutional order flow is really pushing. A key sign of a weak sweep is a lack of displacement. If price just barely tags a liquidity level and then just sits there, it shows indecision. There's no strong, impulsive move away from the level. This suggests the big players aren't committed, and a strong reversal is less likely. If you see multiple sweeps of the same liquidity zone in a short period, be wary. The first sweep might fail. The second one is suspicious. By the third or fourth, the liquidity there is probably being absorbed, and a breakout is more likely than a reversal. And let's not forget the internal red flags. Are you feeling FOMO because you missed a move? Are you chasing price, entering impulsively without your usual confirmation? If you're feeling emotional, that is not the time to be trading a precise setup like a liquidity sweep. Stick to your plan. So, when should you trade them? Only when you have confluence. Build yourself a rule-based filter. Ask: is the sweep happening during an active session kill zone? Is there strong displacement after the sweep? Is it aligned with the higher timeframe bias and market sentiment? Does it line up with another ICT concept, like a fair value gap or an order block? If you can't check these boxes, it's not a trade. It's just noise. Even on your best setups, manage your risk. Keep your position size small, enter on confirmation, not anticipation, and always know your invalidation level. To summarize, knowing when not to trade is as powerful as knowing when to act. It's about patience, discipline, and always prioritizing context over a pretty-looking setup. Stay disciplined, be data-driven, and I'll see you in the next lesson.